It begins, as most things in financial history do, not with grandeur but with fear, the fear of loss, the terror of uncertainty, the quiet realization that life, business, and empire all hang by a thread no thicker than chance. Before there were banks, before there were coins, there was risk. And before risk became a commodity, traded, priced, and packaged, it was an existential curse. The merchant gazing at a dark horizon, the farmer scanning the skies for rain, the ship captain fearing storms and pirates, all were slaves to probability before probability even had a name. To speak of the origins of insurance is to speak of humankind's earliest attempt to civilize chaos. There was a time when every misfortune was blamed on the gods. Thunder was the wrath of Zeus. Drought, the punishment of Enlil. Fate was sacred, and to measure it was heresy. Yet somewhere in the midst of this divine fatalism, a different kind of faith began to take shape, not in the heavens, but in numbers. The birth of insurance, long before the word existed, was nothing less than the slow dethroning of divine chance and the coronation of human calculation. The first seeds were sown in the fertile valleys of Babylon, where clay tablets recorded more than debts and trade. They recorded agreements against misfortune. Merchants sending caravans across deserts would pool resources to share losses should one be robbed or lost. To the modern economists, this sounds like primitive mutual insurance. To the Babylonians, it was something far more profound, a collective defiance of destiny. The Code of Hammurabi, written nearly 4,000 years ago, even contains clauses that describe early forms of risk-sharing among traders. If one man's goods were stolen on the journey, others would compensate him. Thus, commerce and compassion were fused into a single logic, security through solidarity. But human ingenuity, like risk itself, is restless. The ancient Chinese practiced a similar art along the perilous Silk Road. Instead of caravans, riverboats carried goods across dangerous waters. Merchants would divide cargo across multiple vessels to minimize the risk of total loss. This was not altruism, it was arithmetic. The probability of ruin was reduced by distribution, a principle that every modern hedge fund would later enshrine as diversification. Centuries before the first stock ticker, humanity was already learning to manipulate uncertainty into opportunity. Then came the Phoenicians and Greeks, those cunning architects of maritime commerce. Their ships carried more than goods. They carried the logic of risk into the Mediterranean. Contracts such as bottomry and respondentia were devised loans made to ship owners repayable only if the voyage succeeded. If the ship sank, the debt was cancelled. To the modern observer, this was the first time financial loss was explicitly tied to the probability of disaster. The lender was not merely betting on the winds but investing in risk itself. Out of this strange equation, danger plus money equals possibility, the embryo of insurance was born. There is a cruel irony here. The very concept that would one day promise safety began as a gamble. Risk was not abolished, it was monetized. The merchant's courage was no longer heroic, it was calculated. Every voyage became a probability curve, every loss, a data point. This was humanity's first step toward a new theology, one that worshipped not gods, but numbers. By the time of the Roman Empire, the machinery of risk-sharing had matured into something institutional. Roman burial societies, known as collegia, pooled funds so that members could be buried with dignity. On the surface, it was a communal gesture of care. Beneath it was the recognition that mortality too could be budgeted. In this sense, insurance became both moral and mathematical, the fusion of empathy with economics. The Roman understood that death was certain, but the cost of death need not be. Yet what truly distinguishes the ancient origins of insurance is not the paperwork, but the philosophy. For the first time, humankind dared to imagine a world where uncertainty could be negotiated, where misfortune could be quantified, and fear could be sold for a price. What began as a covenant among traders became an epistemological revolution, a shift in how civilization understood fate itself. In a sense, early insurance was the first form of secular faith. It demanded belief not in gods or kings, but in the collective promise of compensation. You would not be left alone when disaster struck, because others had invested in your misfortune. It was a strange kind of brotherhood, a marketplace of empathy. But make no mistake, this compassion had a price. Even in Babylon, the logic was transactional. One's security depended on the coin of another's fear. By the medieval period, this system of trust evolved into something more intricate. The Italian city-states, Venice, Genoa, Florence, became laboratories of financial imagination. The Mediterranean was no longer a sea of exploration. It was a sea of contracts. Merchants and bankers crafted agreements that protected cargo, ships, and even lives. The language of the law absorbed the language of risk. A lost ship was not a tragedy. It was a liability. A successful voyage was not merely fortune. It was yield. From this, a subtle transformation occurred. Risk ceased to be an external force and became an internal calculation. Once people prayed to avoid disaster, now they priced it. Once risk was the enemy of commerce, now it was its foundation. The merchant no longer feared uncertainty, he owned it. This shift was revolutionary, though it arrived quietly. A civilization that once trembled before nature was now building instruments to predict, contain, and profit from it. Insurance, this humble invention of clay and ink, was teaching humanity a dangerous lesson, that fear itself could be commodified, and once a fear could be sold, it could be scaled. The moral implications were profound. What happens when protection becomes profitable, when safety itself becomes a product? The answer, of course, is the modern financial world. Every hedge fund, every futures contract, every credit default swap is the descendant of a Babylonian promise scratched into clay. The logic is identical. Calculate the likelihood of loss, transfer the burden, and charge a fee. But this newfound mastery over uncertainty came at a psychological cost. The more humans believed they could quantify risk, the more reckless they became in confronting it. Insurance did not eliminate danger, it displaced it. A captain would sail further knowing his ship was insured. A banker would lend more knowing his losses were covered. Thus, the calculus of safety became the catalyst of expansion. There is a tragic irony here. The very systems built to protect humanity from ruin have always fueled the next great gamble. The merchant of ancient Babylon, reassured by the safety of his caravan pact, sent twice as many goods next time and lost them all in a sandstorm. The Renaissance trader of Genoa, insured against shipwreck, sent fleets deeper into uncharted waters. The more we insure ourselves against risk, the more risk we create. It is the paradox at the heart of every financial system. Stability breeds speculation. And yet, this paradox is precisely what transformed risk into wealth. For out of the arithmetic of fear emerged a new form of value, one rooted not in tangible goods but in probabilities. Insurance was the first great abstraction of finance. The moment when value ceased to be something physical and became something conceptual. It was no longer about gold or grain, but about the management of the unseen, the odds, the outcomes, the future itself. To measure risk is to believe that the future can be shaped. That conviction, that arrogance, perhaps became the foundation of modern finance. In a sense, every policy, every premium, every contract of protection is an act of defiance against chaos, and yet beneath the rhetoric of prudence lies a deeper truth. Insurance has always been a wager on destiny. The early merchants and lawmakers of antiquity could never have imagined the scale their invention would reach. They sought merely to guard against misfortune. What they created instead was an empire of anticipation, a world economy built on the mathematics of fear. And so the first chapter of insurance is not a tale of comfort but of courage, calculation, and contradiction. It is the story of how humanity, in trying to escape the cruelty of chance, invented an even more intricate form of uncertainty, a financial one. The clay tablets of Babylon were the first risk models. The caravans across the desert were the first diversified portfolios. The ship loans of Greece were the first derivatives. Every modern instrument of finance traces its bloodline to that ancient impulse, the need to turn danger into design. In the end, the origins of insurance remind us that civilization itself is built on the illusion of safety. We insure not because we are rational, but because we are afraid, and our fear-priced, pooled, and packaged became the most lucrative asset in financial history. If Babylon taught humanity to count its fears, then the sea taught it to profit from them. The age of exploration, that glittering, violent century of maps and ambition, was not only the story of discovery, it was the story of financial invention. And among those inventions, none proved more transformative or more cynical than the rise of maritime insurance. For it was here, amid storms and gold, between the compass and the cross, that mankind first turned uncertainty into empire. The oceans of the 15th to 17th centuries were not merely bodies of water, they were balance sheets. Each voyage was a transaction between greed and chance, each sail a gamble against ruin. The merchants of Genoa, Venice, and Amsterdam did not set out upon the waves in pursuit of glory. They set out in pursuit of return on investment. Yet the sea, unlike the ledger, offered no guarantees. One rogue wave, one sudden squall, one pirate with a cannon, and months, even years, of profit could vanish into foam. It was in that terror that insurance found its true purpose, to transform the unpredictable into the quantifiable, the fatal into the manageable. To understand the rise of maritime insurance is to understand the psychology of the early modern world, a world that wished to conquer nature not with swords, but with contracts. The Italian city-states, those shimmering citadels of commerce, were the first to codify risk into policy. Genoese merchants, haunted by tales of lost fleets, began to sign agreements that promised compensation should ships fail to return. The oldest surviving insurance contract, dated 1347, is from Genoa, a mundane document on parchment, yet monumental in implication. It declared, with bureaucratic certainty, that even the sea could be made to obey mathematics. But it was in Venice, that floating republic of marble and money, where risk truly became a business. Venetian underwriters turned the uncertainties of wind and water into a steady source of income. They calculated premiums based on destination, season, and cargo, an early, elegant fusion of statistics and superstition. Sailing to Alexandria in winter cost more than to Ragusa in spring. The gods of the sea had been replaced by the gods of probability. Yet this mechanization of risk was not an act of prudence, it was an act of greed disguised as rationality. The more merchants could insure, the more recklessly they traded. Ships grew larger, routes grew longer, ambitions swelled. Insurance was supposed to reduce danger, but instead it enabled an addiction to it. For the first time in human history, disaster itself became profitable. The merchant who lost his ship might mourn, but his underwriter collected his fee regardless. The house always won, even when the sea devoured the dice. As the Renaissance gave way to the age of exploration, maritime insurance evolved from a local mechanism of security into a global instrument of empire. Spain and Portugal, those twin juggernauts of the 16th century, owed their colonial triumphs not merely to navigators and priests but to financiers and insurers. Without insurance, the galleons of Seville and Lisbon would never have risked the Atlantic, for who would dare send gold-laden ships across uncharted waters without a promise of reimbursement? In this way, the conquest of the New World was underwritten long before it was discovered. The paradox was deliciously cruel. The European thirst for expansion was fed not by courage, but by mathematical reassurance. The promise of compensation transformed exploration into a financial strategy. Every ship became a line of credit, every crew a collateralized risk. The sea, once the ultimate symbol of chaos, was absorbed into the geometry of global finance. It was in London, however, that the modern architecture of insurance truly took form. In the smoky confines of a coffeehouse near the Thames, Lloyd's Coffee House, to be precise, merchants and shipowners gathered to exchange information about ships, storms, and profits. It was an age before telegraphs and newswires, when gossip was the currency of survival. Here, over cups of bitter coffee and ink-stained tables, men began to draft contracts that would define the future of capitalism. They called them policies, but they were in truth the first instruments of financial globalization. By the late 17th century, Lloyd's of London had become the nerve center of maritime risk. The underwriters, wealthy individuals known simply as names, would literally write their signatures beneath a list of insured ships, each assuming a portion of potential loss in exchange for a premium. Thus the very term underwriter was born. These were not philanthropists, they were gamblers cloaked in decorum. The sinking of a vessel was not a tragedy but an event to be balanced on a ledger. Risk had been fully domesticated, turned into a tradable asset. There was, however, an unsettling transformation beneath this elegance. The more the system evolved, the more abstract it became. Once, insurance connected people, a caravan of merchants sharing danger for mutual survival. Now it connected capital, strangers wagering on ships they would never see, lives they would never meet. The intimacy of security had given way to the impersonality of speculation. In this transformation, we see the birth of a new kind of morality, one not based on virtue, but on calculation. The insured man no longer prayed for mercy, he prayed for a favorable clause. The insurer no longer feared storms, he feared insolvency. The world had discovered a chilling truth: to control fear, one must first monetize it. The irony deepened as maritime insurance became entangled with colonial expansion and slavery. The same systems that protected ships carrying spices and silk also protected ships carrying human beings. The infamous Zong massacre of 1781, in which 132 enslaved Africans were thrown overboard so that the ship's owners could claim insurance compensation, revealed the monstrous side of the industry. In that moment, insurance ceased to be merely a financial innovation and became a moral indictment. The transformation of risk into wealth had reached its logical extreme. Even human life could be converted into a claimable loss. Yet the brutality did not halt the machine, it refined it. By the 18th century, marine insurance had become the blueprint for modern financial instruments. From reinsurance to derivatives, risks were divided, traded, and reinsured across borders. What began as a pragmatic tool for merchants had mutated into an intricate global network of speculation. The more humanity understood risk, the more it invented new ones. Still, one must marvel at the audacity. The underwriters of Lloyd's were not merely accountants, they were architects of a new world order. Their policies enabled the voyages that mapped continents, founded colonies, and restructured economies. The insurance policy was as crucial to imperial expansion as the compass or the cannon. It provided the illusion of safety necessary for ambition to flourish. Without it, perhaps the world would have been smaller, humbler, less drenched in both wealth and blood. And here lies the bitter paradox of progress. Every step towards safety demanded a greater gamble. The very institutions created to guard against chaos became engines of it. By absorbing risk, insurance multiplied it. The Spanish galleons insured against storms were captured by pirates. The East India Company's insured cargoes fueled wars in Asia. And in every loss, there was profit for someone. This is the secret heartbeat of financial history. Disaster has always been lucrative. Insurance did not civilize danger, it monetized it. It allowed men to dream beyond prudence, to expand beyond reason. It replaced divine providence with actuarial tables, and in doing so, it gave humanity a new form of faith in the solvency of its own illusions. By the dawn of the 18th century, the transformation was complete. The insurance contract had become the most powerful document in the world, more binding than treaties, more universal than religion. It turned the chaos of the ocean into an orderly market. Every voyage, every tempest, every shipwreck became a data point in the grand experiment of controlling fate through finance. And yet, beneath the mathematics and marble facades, a haunting truth lingered. The sea remained indifferent. It swallowed ships, men, and fortunes without discrimination. The ledgers in London and Amsterdam might balance, but the waves cared nothing for arithmetic. Insurance could redistribute loss, but it could not erase it. The merchants of the 17th century believed they had conquered chance. In reality, they had merely postponed it. This illusion of mastery, the belief that money could outwit mortality, is the defining delusion of financial modernity. It began with a ship, a contract, and a promise that ruin could be priced. The rest was history, or rather financial history, written not in ink, but in premiums and wreckage. So when we speak of the rise of maritime insurance, we are not speaking of a quaint trade custom, but of a turning point in human consciousness. For in that moment, humanity did something unprecedented. It placed a bet against fate, and won for a while. The seas grew tamer, the profits larger, the empires stronger. But the cost of this triumph was subtle and immense. Risk had not vanished. It had migrated from the waves to the world itself. From that day onward, every factory, every market, every financial institution carried within it the same ancient logic born on the ocean. If danger can be shared, it can be sold, and if it can be sold, it can enrich. Thus, the insurance that began as a covenant of survival became the cornerstone of capitalism, the quiet, invisible force that allowed the world to gamble with its own stability. The ships have long since rotted, their timbers buried beneath the silt of forgotten ports. But their legacy endures in the contracts that bind nations, in the risk models that price your life, in the quiet confidence with which we assume the future can be secured. It cannot, of course. But belief is profitable, and profit has always been the most enduring faith of all. History, it seems, has always needed a catastrophe to remember its priorities. For the citizens of 17th century London, that catastrophe came in September 1666, 4 days of heat so merciless, so unrelenting, that the city seemed to burn not just in wood and pitch, but in sin and arrogance. The Great Fire of London was not simply an urban disaster, it was a reckoning. It exposed, in its flames, the fragility of prosperity and, with exquisite irony, gave birth to one of the most profitable industries in human history, modern insurance. Before the fire, London had been a city of timber and denial. Houses leaned into each other like gossiping neighbors, their thatched roofs and narrow alleys forming an architecture of inevitability. The merchants of the city, flush with colonial gold and maritime ambition, insured their ships, their goods, even their own reputations. But the city itself, unthinkable. Who would insure an entire metropolis? To imagine such a thing was to question God's favor. Then the fire came. In a mere 96 hours, it consumed over 13,000 houses, 87 churches, and the grand medieval cathedral of St. Paul's, a ruinous sermon in smoke. The inferno left more than 70,000 people homeless and an entire economy in ashes. It was, in the cruel arithmetic of finance, a perfect opportunity, for while most saw only devastation, a few saw a market. Among them was a man named Nicholas Barbon, a doctor by training, a speculator by instinct, and a visionary by accident. Barbon, who had made his fortune in the rebuilding of London, realized that the city's greatest resource was not its architecture but its fear. Out of that fear, in 1667, he founded the Fire Office, the first commercial fire insurance company in the world. His innovation was both practical and poetic. For a small annual premium, property owners could purchase a promise that, should the flames return, their losses would not consume them twice, once in fire, and again in bankruptcy. Barbon's idea was revolutionary, not because it soothed ruin, but because it monetized it. The Fire Office employed its own fire brigades, men who wore the company's crest and saved only the buildings insured under their policy. If your home bore the Fire Office plaque, a small metal badge of salvation, you were protected. If it did not, well, the flames were your problem. Thus, insurance became not just a service, but a privilege, a system that sorted survival by subscription. This was capitalism's quiet genius. Even catastrophe could be made selective. But fire, like finance, has a habit of spreading. Barbon's competitors soon followed, and London's skyline filled with rival insurance marks, each declaring allegiance to a different firm, the Hand in Hand, the Sunfire Office, the Royal Exchange Assurance. By the early 18th century, insurance plaques glittered across London's rebuilt walls like talismans of modernity. The city had become not merely a place to live, but a portfolio to protect. Yet behind this newfound security lay something darker. Insurance was not born from empathy. It was born from calculation. The policyholder was not a neighbor to be helped, but a client to be priced. Premiums were determined by neighborhood, by material, by proximity to the river. Risk was dissected, categorized, monetized, and in doing so, society itself began to be divided by the cost of its vulnerability. The poor, unable to afford premiums, were left to burn again. Still, London adored its new faith in financial protection. The fire, once a symbol of divine wrath, had been domesticated into an actuarial equation. What had been fate was now forecast. And with every brick laid and every premium paid, a new psychology emerged, the belief that money could preempt misfortune. It was a seductive delusion. As the 18th century unfolded, insurance expanded its empire. What began as a safeguard for property soon turned its gaze toward something even more intimate, human life itself. If houses could be valued, why not hearts? If ships could be compensated, why not souls? The logic was grotesquely consistent. In 1706, a group of London merchants founded the Amicable Society for a Perpetual Assurance Office, the world's first life insurance company. Its name, Amicable, reeked of moral gentility, but its function was pure mathematics. Members paid annual premiums, pooled into a collective fund. When one of them died, his family received a share of the pot. It was, in essence, a wager on mortality, a polite lottery of death dressed in the language of prudence. But even death, it seemed, could be optimized. The real breakthrough came in 1762 with the founding of the Equitable Life Assurance Society, which introduced actuarial science, a discipline so coldly rational it could price the unthinkable. The Equitable's founders employed mathematicians to analyze mortality tables, calculating life expectancy with the precision of celestial mechanics. For the first time, the value of a human being could be determined not by lineage or virtue, but by statistics. It was, of course, the perfect invention for an age intoxicated by reason and empire. Insurance transformed from a moral promise into a financial instrument, a machine for quantifying destiny. The London coffeehouses where gossip once guided wages on ships became temples of data and mortality. The same intellectual spirit that mapped the stars now mapped the lifespan of clerks. The Enlightenment, in its luminous arrogance, had found a way to rationalize the oldest mystery of all, death. And yet, the deeper humanity delved into quantification, the more it distanced itself from compassion. Life insurance, for all its rhetoric of care, served primarily the wealthy men with estates to protect, families to preserve, and debts to secure. The poor, as always, remained uninsured and expendable. In the polite parlors of London, gentlemen discussed policies as they might discuss poetry, unaware or perhaps indifferent to the fact that they had transformed mortality into a commodity. Still, society embraced the illusion. Life insurance promised continuity in a world governed by chaos. It transformed death, that great disruptor, into a manageable transaction. To die, under a proper policy, was not to vanish, but to settle one's accounts. The widow wept, the underwriter smiled, and the machine continued. It was during this period that the true moral inversion of insurance became evident. What had begun as a communal defense against misfortune had become a private strategy for profit amid peril. Insurance companies, flush with premium capital, began investing their reserves, first in government bonds, then in trade, then in colonial enterprises. The money collected to guard against disaster was used to finance risk itself. Thus, insurance became not merely reactive but generative, feeding the very system of expansion that made insurance necessary. The irony was almost divine. By the late 18th century, insurance had woven itself into the fabric of empire. The British East India Company insured its ships, its warehouses, even its soldiers. The profits of fire and life insurance funded colonial trade and military ventures, binding the domestic safety of London to the global peril of conquest. Risk, once local, had become imperial. In this new order, security became speculation, and speculation became civilization's heartbeat. The same mathematics that measured house fires and heartbeats now measured markets and wars. Insurance was no longer a service. It was a worldview, the conviction that every uncertainty could be priced, every tragedy could be monetized. Yet even as it enriched nations, it hollowed out the idea of safety itself. For in turning risk into profit, insurance ensured that risk would never vanish, only circulate. The city rebuilt after the Great Fire stood taller and grander, but also more vulnerable. Its wealth was insured, but its soul was mortgaged to the mathematics of fear. One might say that London's rebirth after 1666 was the moment when modernity sold its conscience. The city learned that survival could be systematized, that ruin could be reversed with a signature, that even divine wrath could be managed with a premium. It was an extraordinary achievement and an irreversible one. In the centuries that followed, the concept of insurance would metastasize from fire to life, from sea to stock exchange, from individuals to entire nations. But its essence would remain unchanged, the quiet conviction that risk, properly measured, could be turned into wealth. And yet, beneath the triumph, a whisper persisted. It was the same whisper that echoed through the smoke of 1666, the same one that haunted the underwriters of Lloyd's as they signed their names beneath lists of doomed ships. You cannot insure against fate, but humanity, ever defiant, would keep trying. It would build empires on policies, economies on premiums, and faith on probability. The flames that once devoured London had taught the world an immortal lesson that out of ruin comes order, and from fear comes fortune. In that paradox lies the brilliance and the tragedy of financial history. The 19th century was an age of smoke, steel, and staggering confidence, an era that believed itself immortal. Chimneys rose like cathedrals, railways sliced through continents, and factories pulsed with the relentless rhythm of progress. Humanity, armed with machines and mathematics, declared war on uncertainty itself. And in this grand battle against fate, insurance became not just a business, but a doctrine, the secular religion of modernity. The Industrial Revolution did not simply produce goods, it produced hazards. Steam engines exploded, mines collapsed, railways derailed, ships vanished into industrial fog. For every triumph of invention came an equal and opposite disaster, as though the gods, unwilling to be erased, demanded tribute in accident and flame. But where previous generations had seen divine wrath, the Victorians saw opportunity. Risk, after all, was no longer a moral failing, it was a market. Insurance, reborn in soot and ambition, rose to meet the age. The factory was both a miracle and a menace. Within its iron walls, men and women worked beneath belts and pistons. Each movement synchronized to the logic of capital. Accidents were inevitable, limbs crushed, lungs blackened, lives shortened, and with them came a new kind of arithmetic. The cost of injury, the value of replacement, the price of survival. Industrialists, eager to protect their empires from financial ruin, turned to insurance not out of compassion, but out of necessity. A single fire could devour years of profit. A single lawsuit could tarnish reputation. Thus emerged industrial insurance, the mechanism by which capital shielded itself from the very human wreckage it produced. Factories began insuring their machinery, their inventories, even their workers, not out of benevolence but out of calculation. To insure a worker was cheaper than to lose one. A small premium now prevented a large payout later. In this cruel calculus, compassion and cost merged into one. And so the age of progress built its moral justification. Industry could now maim without guilt, for it had paid in advance. The insurance companies themselves became industrial entities. Once small, gentlemanly offices on London's Lombard Street, they grew into bureaucratic fortresses, with clerks, actuaries, inspectors, and vast ledgers cataloguing the fragility of modern life. Every accident became data, every death, a statistic. The 19th century's great illusion was that if one could measure misfortune, one could master it. Insurance thus became the mirror of modernity, cold, efficient, and terrifyingly rational. But the ambitions of insurance could not be confined to the city or the factory. The same forces that powered locomotives and steamships carried the concept of risk across the seas. As Britain's empire expanded, so too did its appetite for control, and insurance was its invisible infrastructure. The East India docks of London, crowded with ships bound for Bombay, Hong Kong, and Cape Town, were not merely scenes of trade. They were theaters of financial conquest. Every voyage was insured, every cargo hedged against the unpredictable moods of wind and water. To insure a ship was to colonize uncertainty itself. Insurance made empire mathematically possible. It transformed peril into projection, allowing merchants to invest in voyages they would never see, in lands they would never visit. It was the quiet machinery behind imperial confidence, ensuring that even when a ship sank, the profit did not drown with it. But this globalization of risk carried its own moral corrosion. Insurance companies, flush with colonial wealth, began underwriting ventures of conquest and exploitation. Slavery, opium, and indentured labor all were, at one time or another, insured. The human cost of empire was not abolished, was amortized. The underwriters of London's Lloyd's, sitting in their polished coffeehouse, knew well what they were signing. A slave ship insured for loss of cargo was not an abstraction. It was an accounting of bodies. When a captain threw enslaved Africans overboard to collect an insurance payout, as in the infamous case of the Zong in 1781, the courts debated not murder, but liability. And in that legal precision lay the century's moral rot. Insurance, the very thing that promised stability, had become the ultimate moral anesthetic. It allowed civilization to profit from cruelty without feeling it. While the empire extracted wealth from the world, the insurance companies extracted order from chaos. The 19th century was obsessed with measurement of time, of motion, of human value. The great innovation of the period was not the steam engine, but the actuarial table. Mathematics, once the domain of philosophers, had been weaponized by actuarial science grew into an empire of its own, quantifying risk with the same authority that physicists measured gravity. Every life insured became a data point. Every premium, a moral decision disguised as a number. With this came a new arrogance, the belief that chance itself could be domesticated. The insurance clerk, pencil in hand, became the priest of this secular faith, translating suffering into predictable patterns. Mortality, once feared as the great unknown, was now a curve on a graph. This statistical revolution did more than protect investors. It reshaped society's understanding of fate. It taught individuals to think in terms of probability, not providence. The poor learned to see their poverty as risk exposure. The rich learned to see their wealth as risk management. Life, in its totality, became an equation, and insurance was the answer key. But beneath the precision of the tables lay a deeper paradox. The more humanity tried to control risk, the more risk proliferated. Industrial cities bred disease, railways brought crashes, financial speculation birthed crises. Each new innovation required new insurance, and each new insurance created new confidence, a self-feeding cycle of progress and peril. Thus, the very thing that promised safety became the engine of danger. By the late 19th century, insurance had become a symbol of civilization. To be insured was to be modern, prudent, respectable. The middle classes, newly ascendant and anxious, saw in insurance a way to imitate the calm of aristocracy. Advertisements promised security, dignity, and peace, all purchasable in monthly installments. The industry's propaganda was masterful. Posters depicted smiling widows, thriving children, and sturdy homes protected by invisible shields of policy. Insurance had found its emotional language. It no longer sold numbers, it sold reassurance. And yet, behind the glossy veneer, the system remained brutally impersonal. Claims were denied on technicalities, premiums adjusted to discriminate by age, health, and class. The insurance company, once imagined as a guardian, revealed itself as a gatekeeper, a machine that monetized both fear and faith. The irony was inescapable. A system created to mitigate risk had itself become a risk to trust, but by then, it didn't matter. Society was addicted to certainty, and insurance was the dealer. Meanwhile, industrial accidents reached biblical proportions. In the coal mines of Wales, in the textile mills of Manchester, and the steel furnaces of Pittsburgh, men were dying faster than the policies could be printed. But their deaths no longer halted production. They were already accounted for. Insurance had transformed mortality from tragedy into logistics. The worker's body had entered the balance sheet. By the dawn of the 20th century, insurance was everywhere, invisible yet omnipresent. The nervous system of global capitalism, shipping lines, telegraph cables, factories, banks, and even empires themselves were connected by contracts of indemnity. A fire in Chicago could ripple through the markets of London. A failed crop in Bengal could unsettle insurers in Paris. This was the globalization of risk, not as disaster, but as design. The world had been turned into a network of contingencies, each insured against the other. It was an elegant illusion that interdependence equaled safety, but in truth, it only meant that when catastrophe came, it would come everywhere at once, and come it did. In 1906, the San Francisco earthquake destroyed nearly 80% of the city. Insurance companies across the Atlantic were crippled by the payouts. Some collapsed entirely. The disaster revealed the hidden fragility of the system, that beneath its mathematical poise lay a chain reaction waiting to ignite. The modern age had succeeded in spreading risk, but not eliminating it. The lesson, of course, went unlearned. For insurance, like all financial miracles, thrives on amnesia. By the eve of the First World War, insurance had become indistinguishable from empire and finance. It underwrote the war bonds that fueled destruction, the factories that built weapons, the ships that carried soldiers. Risk and reward had finally become one. The very notion of safety had been consumed by the machinery of speculation. In the smoky offices of London, Paris, and New York, actuaries drew their curves. Underwriters stamped their seals, and the illusion of control persisted. But in the trenches of Europe, as millions fell to shellfire and disease, the true cost of ensuring civilization was being paid in blood. The industrial age had achieved what no civilization before had dared. It had globalized risk and commodified catastrophe. And in doing so, it had revealed the final irony of insurance, that by turning danger into profit, humanity had ensured that danger would never disappear. Safety, it turned out, was just another investment, and like all investments, it demanded interest. The 20th century did not inherit safety, it inherited confidence. The world that emerged from the smoke of factories and empires had learned to place its faith not in gods or monarchs, but in the arithmetic of risk. Humanity, armed with the instruments of insurance and the ideology of finance, believed it had tamed uncertainty once and for all. But beneath this belief, this serene, bureaucratic hubris, lay the greatest illusion of the modern age, that risk could be eliminated rather than merely traded. By the dawn of the century, insurance had ceased to be a protective measure. It had become an engine of finance, a mechanism not only for guarding against loss but for creating wealth itself. Policies became securities, promises became commodities, and somewhere between the underwriter's ledger and the banker's balance sheet, the moral vocabulary of safety was replaced by the cold grammar of speculation. It began innocently, as revolutions always do. Insurance companies, flush with capital from industrial premiums and life policies, found themselves sitting on mountains of idle cash. To leave it dormant was wasteful, to invest it was genius, so they lent it to governments, corporations, and banks, thus turning the very funds meant to protect against catastrophe into the fuel of capitalism. This shift marked a profound transformation. No longer were insurers merely guardians of stability, they were architects of liquidity. Their reserves flowed into railways, infrastructure, real estate, and later, into the speculative veins of Wall Street. Safety became synonymous with profit. By mid-century, insurance companies had become the quiet sovereigns of modern finance. Their balance sheets dwarfed national budgets. Their decisions rippled through economies like invisible legislation. The promise of indemnity had become indistinguishable from the pursuit of return. Risk was no longer something to be mitigated, it was something to be engineered. The language of protection gave way to the jargon of markets. Derivatives, hedging, risk tranching. To insure no longer meant to guard against disaster, but to bet on its predictability. The very instruments designed to shield society from uncertainty were now amplifying it in forms too complex for any single mind to comprehend. And yet, the illusion held firm. The more abstract finance became, the more secure people felt. The policyholder in Tokyo, the investor in New York, the pensioner in Manchester all believed they were wrapped in invisible safety nets spun by mathematical precision. They mistook complexity for control and leverage for protection. It was, in essence, the oldest lie in financial history, only now written in the language of algorithms. The 20th century's greatest innovation was not the airplane or the transistor, it was the welfare state. After 2 world wars and a global depression, governments around the world discovered that social stability required a new kind of insurance, not for ships or factories, but for citizens themselves. Social insurance, once a radical notion, became the moral scaffolding of modern democracy. Health, unemployment, pensions, all were absorbed into a national calculus of risk. The state, once the collector of taxes and arbiter of law, became the ultimate insurer of last resort. Bismarck's Germany had pioneered the model in the late 19th century, but it was the mid-20th century in the ashes of 1945 that truly globalized it. Britain introduced the National Insurance Act. America expanded Social Security. Japan and France built their welfare networks on the ruins of empire. This was the apotheosis of the insurance idea, collective indemnity as a moral right. For the first time in history, risk was not merely priced, it was politicized. The social contract became a policy, and the citizen became both insured and insurer. But this transformation carried its own irony. In making security a public good, states also made it a currency of power. The welfare state promised protection, but demanded obedience. Its safety nets were woven with bureaucratic strings. Insurance had always been an instrument of calculation. Now it became an instrument of governance. And yet people embraced it willingly. After centuries of fire and famine, plague and poverty, the promise of cradle-to-grave coverage was intoxicating. Humanity had finally achieved what medieval priests could only preach: salvation through subscription. Still, the mathematics of social insurance obeyed no miracles. As economies expanded, populations aged and crises accumulated, the cost of collective security began to rise. The very success of the system, its promise of stability, generated its own unsustainable expectations. By the late 20th century, the state's role as insurer was no longer benevolent, it was burdensome. The promise of total protection had become the price of political survival. The second half of the 20th century marked a return, not to caution, but to confidence. If the post-war world had built safety through solidarity, the neoliberal age sought prosperity through risk. The reforms of the 1980s, deregulation, privatization, globalization, dismantled the moral architecture of collective protection and replaced it with the glittering machinery of individual speculation. The mantra was simple: let markets manage risk, and so they did with spectacular audacity. Insurance companies became investment giants. Investment banks became insurers. The distinction between risk coverage and risk creation dissolved. The market itself became one vast actuarial experiment, its probabilities hidden in spreadsheets and its dangers disguised as opportunity. By the 1990s, entire economies were operating as derivatives of derivatives, insurance layered upon insurance. Until the original asset, the original reality, had all but vanished. Financial instruments like credit default swaps and collateralized debt obligations were celebrated as triumphs of modern ingenuity. They promised to distribute risk so widely that no one would ever suffer it. It was a lie too elegant to resist. In truth, the system had only concentrated risk invisibly, silently, in institutions too vast to fail and too arrogant to admit vulnerability. Insurance had completed its historical metamorphosis from a tool of prudence into a weapon of speculation. The very concept that had once tamed chaos now manufactured it. And when the illusion finally shattered, as it did in 2008, the result was biblical. The collapse of Lehman Brothers, the near-death of AAG, the implosion of mortgage-backed securities all revealed a simple truth. The world had insured itself against everything except its own greed. The financial crisis was not a failure of regulation, it was a failure of imagination. Humanity, having conquered nature, disease, and distance, had convinced itself that it could conquer uncertainty itself. But risk, like gravity, cannot be abolished, only deferred. And when it returns, it demands compound interest. As the 21st century dawned, the world once again promised itself immunity, this time not through paper contracts, but through data. The new prophets of risk wore hoodies, not suits, and spoke the language of algorithms, not actuarial tables. Insurtech, fintech, blockchain risk solutions. These were the hymns of a new religion. Artificial intelligence could now predict everything: your likelihood of illness, your credit default probability, your lifespan, your moral reliability. The machine, unburdened by emotion, could calculate fairness with mechanical purity, or so we were told. In truth, the algorithm merely replaced one prejudice with another, only now it did so with mathematical authority. The poor remained more risky. The sick paid more. The insured became data points in a digital marketplace of vulnerability. And once again, risk became not something shared, but sorted. Insurance had become surveillance, a mirror held up not to fate, but to behavior. Every purchase, every search, every heartbeat recorded by wearable devices became part of a vast actuarial panopticon. We no longer feared the unknown. We feared being known too well. And so we returned to the question: what made the concept of insurance transform risk into wealth? The answer, after 4 centuries of progress and pretense, is disarmingly simple: belief. Humanity believed that risk could be priced, and in that belief created a market powerful enough to reshape civilization. It was not the mathematics that built the modern world. It was the faith that mathematics could master the unpredictable. Insurance did not abolish risk, it institutionalized it. It transformed danger into a tradable asset, catastrophe into a revenue stream, and mortality into a predictable dividend. It made uncertainty itself the raw material of prosperity. And yet, for all its brilliance, the system has never escaped its paradox. Every new safeguard generates new exposure. Every mechanism of protection breeds complacency. The greater our confidence in control, the deeper our entanglement in chaos. The story of insurance is the story of modernity itself, a triumph of intellect haunted by its own hubris. From the ashes of London to the skyscrapers of New York, from the coffee houses of Lloyd's to the digital clouds of Silicon Valley, humanity has pursued one impossible dream: to profit from fear without feeling it. But history, as always, collects its premiums. For when the next great shock arrives, whether by algorithmic collapse, climate catastrophe, or systemic contagion, the illusion of invincibility will burn away, revealing once more what the Great Fire of 1666 already taught: that security is never guaranteed and that wealth born from risk will always remain hostage to it. And perhaps, in that revelation, we'll remember the truth: insurance was meant to disguise that risk is not an error to be corrected, but the price of being human.